Okay, so just a really quick, I wanted to do a little bit of a pep talk here and a little bit of uh, just kind of reset things for a bit, just to remind us what's going on, what we're supposed to be doing, and what we're supposed to keep focused on. As you know, every single morning, like right before the open, I try to tell everybody to focus and concentrate and so forth. Michael Rosen also reiterates the same sort of uh, uh, condition as well. We just have to keep ourselves focused on what's happening here. Okay, so let's just talk for a second about what happened last month. Um, let's not um, mistake brilliance or genius for a bull market. Okay, um, we were pretty much involved in a market that went straight up, but who the hell knew that was going to happen December 29th, which was the last day of the year, the market absolutely just got slammed in the last hour and a half. Anybody remember that? I certainly do. And we need to stay focused on what's going on and pay attention to what the market is telling us each and every day. Okay, so just pay attention to the signals of the market. Did we get overbought? Absolutely. 5.5% run in January, that is unsustainable. Now, after pulling back, well, maybe we're up about 1.5% year to date. That's probably a little bit more like it. Um, so, so you take advantage of the good times when they happen, when they're there. We don't need to know the reasons for it happening, do we? I certainly don't. I'm just the fact that the opportunities are there right in front of me and right in front of you. You take advantage of it. And if you've been sitting there wondering, oh, and now for the last 2 or 3 days, if you're sitting there stewing and feeling sorry for yourself because you had all these profits and all these gains maybe on the table or on paper last month and you didn't take any money off the table, well, shame on you. All right. I'm going to tell you that right now. I've been telling you day after day, two, three, 4 times a day, suggesting that you take some money off the table when you can, when you're able to. Because on days like Friday and on probably like days like today, all right, it's very, very difficult. It's very, very hard not only from a psychological standpoint, from a money standpoint. You're going to find no bids out there again today. And when there's no bids out there, the spreads between the bid and ask on options are very, very wide. So, excuse my French here, you're going to get screwed coming in, you're going to get screwed going out. Okay? So if you really need to raise some cash and get out of a position, I'm sure there's going to be some market maker who's going to be very, very happy to do business with you because there's nobody else on the other side of the trade. Okay? So, like I said, it's very, very difficult, very, very hard to navigate in a market like this. Much easier a couple weeks ago, right? When there was a lot of bids and people were happy and people were buying, the markets were going up, blah, 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 blah. Those conditions are great for selling. Okay? Maybe adding, maybe rolling, doing whatever you got to do, taking money off the table, raising cash. This is what we've been trying to do for the past couple of weeks. And have our accounts been hit for the last 2, 3, 4 days? Absolutely they have. Okay? That's just part of the process, part of the game. If we're in the markets on a perpetual basis, not a periodic basis. I don't know anybody who could time the market so well that they say, okay, today's the day I'm going into cash 100% because the market's going to get slammed, and then have them be right over and over again. Maybe once they get it right, maybe twice, but you can't get. That's just luck, and you can make your own luck, but you can't keep getting lucky over and over and over again and be able to sustain yourself. Okay, so let's just talk about things for a little bit. All right. I guess I'm not angry or whatever like that. I just want to make sure that you guys all understand we have a job to do, and our job is to make money, right? Our job is to preserve our capital. Our job is to take stuff off the table, take stuff off the board when we have it. I mean, I would get messages from some people. Why are we selling? Why are we selling? The market's going up. Why aren't we buying like everybody else is? And that's the problem. In and of itself, that is the problem. We don't follow what other people are doing. Pay attention to what the market is doing. Do you understand the difference, everybody? We look for the signals. We look for the signs. We pay attention to what the market is telling us, not what Joe Blow mentions on CNBC. Okay, so let me just talk about a couple of things over here. So volatility right now, and I'm going to just put up a couple of charts over here. You guys should be able to see these in just a second here. Let me see here. So I'm going to try and put some rationality and some facts here. So this is the volatility futures term structure, okay? And you got the gold over here, which is, everybody can see my charts, I hope. You got the gold over here, which is the VIX cash, which is ticking up at about 18, 19 or so right now. And we have a slight inversion or backwardation on the curve here, term structure, right? But I would say, by and large, this is a flat term structure right now. Flat. Can everybody see that? Flat? And flat is not good for equity markets, at least in the short term, right? It's gonna trigger a lot of volatility over here, and we did see some of that rise in the 9-day volatility, which is the VXST, which is, I'm really kind of curious that early in the day on Friday this wasn't up that much at all, but then it really soared towards the end of the day. All right, we talk about often from time to time the golden ratio, which is the VIX VXV, which you can see over here, closed at 1.11. So that's a trigger. That's a red flag for the bears, meaning that we're probably way oversold here. All that tells us is that the VIX is higher than the 90-day out, which is the April right over here. Okay, it's roughly April. It's between here April and May, so it's right in between there. So let's just call it 1530. Regardless, it's well above that. So when that ratio is over 1, that's that's pretty close to a sell signal, a buy signal, or an oversold, much stronger oversold signal than we've seen in the past. Okay, oscillators are pretty much washed out here. I'm going to put up the S&P 500 chart first, but I'll bring up the oscillators in just a second. Actually, you know what? Let me bring that up right now for you, and I can show you off of the McClellan report. Let me bring that up here. So I get the McClellan MC oscillator, McClellan oscillator report every day sent to me. So here's Friday's numbers. Everybody should be able to see this in just a second. Everybody see that right there? So the NICE oscillator closed at minus 271, the NASDAQ at minus 208, and the NASDAQ 100 at minus 8, which is a pretty high. Usually when it's at minus 10 or higher, it's really oversold. The number to watch here is a really important number here is this one right here. This oscillator to 0. This if we stay down today and close lower, this number will get over plus 5,000. That's a very large number. That gets us to like the ridiculously oversold level. Okay. So NASDAQ at minus 3,600. If that gets to 4,000 today, that's another one that's going to be extremely exhausted and oversold. So what we've seen in the past, and this in my experience, is that when we get the rubber band gets pulled back really far like it is right now, and maybe even get even further back today, there's going to be a massive snapback rally coming up within a couple of days. Don't pin me to the exact moment, please. Okay? But there's going to be a humongous snapback rally within a couple of days. So I did put a lot of puts on Friday near the close in the last hour or so. They worked a little bit, and they may work a little bit today, but I'll be looking to take some of those off later on in the day. I was looking for a move down much further in the S&P and the futures, but look, I'm not gonna. I can't trade, and neither can you, on assumptions. I can't say to myself, "Oh, we got to go here, we got to go there." We can think about it. We can have a plan, right? So here, let's go to the S&P 500 chart here. Okay, the plan, and I talked with Leanne and a few other people. I faxed some of my smart friends as well too. Talked about this over on Twitter, and I got emails from some people. What would be a natural falling point over here? Anybody? Give me a number. What would be natural to see the markets bounce off of sometime in the next couple of days? The 50-day moving average. That's right, Tony. That's about 27.15. So, ideally, I mean, the markets won't set up exactly what we wish it to be at all times, right? We have to come in with the plan and adjust ourselves accordingly. But for the most part, yeah, that 50-day moving average is probably a good area. Is that an area we want to buy? Well, listen, if we hit extremely ridiculously oversold levels and we hit that number and we stop going down, bam, I'm going to be buying some calls and looking for the ride up probably a couple weeks out. But for now, we're kind of in what's called a no man's land. We're kind of in a dead zone over here. So Matt, 2,700 maybe for a round number over here, but I think for right now, 27.15, and then if we shoot through that 50-day moving average, I would say that 2,700 probably lines up pretty good. There's a gap just around 27.16, which is right around over here. 27.16, 27.18 from just after the first of the year. And then, of course, the first trading day of the year, we gapped up the following the first day. So that's these are some levels that may get filled. Clearly, the MACD is rolled over here. It's negative. It's in kind of corrective mode. But I think what's flooring a lot of people these days is the speed, the quickness of these moves, right? There's if you've been bearish for this period of time, the pain that's been delivered hasn't been really swift, but it's been painful and it's been difficult to handle. If you're bullish and this stuff is going on right now, it's swift, it's painful, and you're feeling it, even though we all know markets have got way overextended and they were entitled to pull back, right? Raise your hand if you don't think the markets are entitled to a pullback. Markets go up, markets go down, okay? And that's why during this month of January we were trying to take money off the table whenever we had the opportunity to do it, okay? I'm gonna Keaton asks, can you explain the VIX ratio? I mean the VIX VXV. Okay. Give me a couple minutes. I'll go and try to get that done here. Let me finish up over here. So we're kind of in a no man's land over here. Now I saw when you see the oscillators this heated up here all the way to the negative side, you'd say, okay, that's probably setting up for a good buy signal over here. However, it's got to be, we want to see it coupled with something else. We got an overshoot reading, of course, on the VIX, right? Now here's the VIX term structure on VIX Central over here. Again, a flat curve, and we have the VIX, these are all updated prices for the VIX futures for today, and the VIX cash is up near 1844. You can see it over there, and all the VIX futures are over here. So again, we're kind of flat on the term structure, but the cash is up in the 18 range over here, and it's going to open up solidly higher. All right. But what didn't happen we didn't get enough fear coming in. Now, the fear and greed index was down to 40. It's now showing fear. Okay. We have VIX spiking up here. Swelling or spiking up here, and we have the oscillators. But what didn't happen on Friday? We had too many call buyers on Friday. And how do I know that? We would look, if you take a look at this graphic over here, you see the total put call ratio is at 0.9. All right, 0.9. So that's 90%. We would normally see on a day like Friday, this should have been about 1.2 or maybe 1.3. But it wasn't high enough because there was too many call buyers coming in. What are those call buyers doing? Those call buyers are coming in believing that this is a great dip to buy. I got to get in there and buy the dip. Oops, that was wrong. So we need to see this number swelling over here. Excuse me. We need to see this number swelling over here to well over 1. So what does that mean? That means we probably have probably have some more downside, right? And it kind of lines up with the theory that we talked about just a second ago. Maybe there's another 1.5% to 2% down in the S&P 500. Now, you want to get it done quickly, right? Quickly and swiftly. But I'll tell you what, the faster markets go down, the more they slice through those those levels that we set in there. So if the market goes down really, really fast or something like that, this 50-day moving average is going to get breached like a hot knife through butter. All right. So you've got to be able to recognize and wait for it. I'm telling you this: wait for the markets to stop going down. You don't have to be the first one in. You don't have to be the second one in. You don't have to be the fifth one in. You just have to wait until the market stops going down before you get involved. Okay? Can you please all do me a favor? Just if you don't do anything else, just wait. Just wait. If you got some puts on, hold on to your puts or roll them down or something like that. I don't think you want to go ahead and sell puts below the strike to create a put spread or something like that. That's usually a good idea. But in this particular moment right now, just wait. Just wait. Okay. Couple other things I want to cover here before we go. I'll get to that VIX VXV in just a second here, Keaton. We talked about the oscillators, put call ratio, VIX term structure, 50-day moving average. And again, I still think you can buy some protection. It's still pretty cheap. The market volatility is starting to get really, really obnoxious right now. But that's just a function of what we have currently, with people getting freaked out with the market behavior here, and they're worried about losing those gains from back in January, understandably, right? We're going to have probably a slingshot rally soon. I don't know when again, but these things tend to happen in a big way when volatility is up. We have not had a period of really high volatility for quite some time, right? I mean, sustainable volatility. We've had spikes, right? We've had lots of spikes. I'll bring the daily chart up here on the VIX. We've had spikes on volatility but not a sustained uptrend. And look, the VIX has gone. Well, the market was up in January from 9 up to 17. It's more than doubled, right? So, and we're over 18 right now in the VIX future. So we're going to be probably opening up around 18.5, 19. That's some pretty severe strength and volatility here. Is it going to last? I don't know. I mean, we'll see what happens. Like I said, the longer term trends are still down around 10, 11%. I don't know if we're going to get back down there. It's looking to me that probably around 12 is going to be our 1150 to 1250 is our bottom on the VIX, just based on some of the action that I saw here earlier in the month of January. But we'll see what happens. We have a slew of Fed speakers out this week. I think 7 of the Fed members will be speaking this week, so it's something you also want to keep an eye on. I don't see Jay Powell on the list, though, although he may have something that coming out later on in the week. But we do have 7 other Fed governors speaking, some hawkish and some dovish, so we want to keep an eye on that as well. And then finally, I'll get into the VIX in just a second. We have a good, strong economy right now, right? But what does the stock market do? The stock market is a discounting mechanism. So if you think that the stock market is discounting today's economy, the jobs market, the GDP, productivity, everything like that, you'd be wrong. Okay? The stock market was pricing in today's numbers last summer. Okay, so today's stock market is pricing in activity out to where? Maybe August, September, October of this year, 6, 8, 9 months from now. All right, you got to lose that connection there, that the stock market today is reacting to today's numbers. That's just not true. That's not how it works. The stock market is a discounting mechanism. It discounts the future, discounts future earnings. Okay, cash flows. So that being said, right, don't correlate. If you see good numbers, good economic numbers, and you think that, oh, well, we have good economic numbers, they're supporting the stock market. That's not true. Okay. Now let's be realistic here. Trends are strong and they last for a very, very long time. So if we the economic growth picture has been mildly good for the past 6-7 years. All right, we had a couple of quarters that were bad, but we had some momentum and some trajectory over there, and now with some fiscal stimulus perhaps and tax cuts for the middle class and for corporations, we might have something that could work for the stock market down the road for the next 8 to 12, 13 months. The jobs market is good. The jobs market is strong. Wages were okay in the jobs report that came out last Friday. Productivity, I was a little disappointed in that productivity number that came out on Thursday. We should be performing at a much higher pace, but maybe that's another. I think that's a lag number, so we might see productivity pick up in the next quarter or two, second to third quarter. But the economy is still very, very strong, and but again, the stock market is not reflecting the economy right now. The stock market is going to reflect what the economy is going to look like down the road. All right. And I just think that maybe in January, markets really just got ahead of themselves here. 5.5% gain in January is not sustainable. On an annualized basis, that's 60%. The stock market is not going to go up 60% based on the numbers that we have. Otherwise, we would be creating a massive bubble like we had back in the late 90s and early 2000s, and it would blow up in everybody's face. Okay. So that's that. So Keaton asked me to talk about the VIX VXV ratio and why it's good, because when there's too much panic going on, and we see, okay, let me see if it, look at the VIX-MO. Oh, it's not in here. They don't have the VX. Oh, here it is. Okay, sorry. Okay, so VIX VXV. VIX VXV is 1.07 right now. You can see that, right? On the left-hand side. And that just means that people are buying a lot more protection on the short end of the curve, which means that the VIX is 30 days, the VXV is 90 days. And that tends to be a little bit overdone. In the past, we've seemed to always witness, not always, but most of the time witness, that when this ratio gets over 1, it's a little bit too overdone, too overheated, and too much selling going on, and people just panicking too much, and a reversal is going to be at hand. Again, we have to wait until the right conditions get there before we see a reversal. This could stay above 1 for a few more days, right? You don't buy the first time you see something, you see a signal, unless the conditions are really good. Again, that oscillator, very, very oversold. In fact, even if you read Tom's report up here, he's still bullish. He says this is a great oversold opportunity with what is still in an uptrend. Well, he doesn't do options. He does stocks, right? And he's a market timer. All right. He wants to time the market exactly, perfectly, and he's terrible at it. Most people are. I mean, I like Tom. He's a great guy, but he would admit as well too that timing is not anything that is for anybody to rely on. And when you see the oscillators down in the minus 270, it gets very attractive and it gets very interesting to want to jump in there and say, okay, this is it. I'm going to catch this bottom. Well, don't do it. Wait until the market stops going down. Have I said that like 3 or 4 times already? With emphasis, right? So let's just sit back and wait and see how things go. There's going to be a good rally coming within days. Do you have to be in there right at the bottom? No. I mean, why do you need to be in there at the bottom? Because you're going to pay up for premium, right? If the VIX is up, what does that tell? What does it tell us when the VIX is up? Options are cheap or expensive, or they're still rather cheap. But are they option prices rising or are they falling? Premiums. Anybody? No, they're rising, right? Option premiums are actually rising, right? They're getting more expensive. Options are getting more expensive when the VIX is climbing, right? So when the VIX is falling, options are getting cheaper. So if you want to jump in there right now, When the VIX is 1850, you're going to pay up for some calls. If you want to buy calls right now, you're going to pay up for it. And at the end of the day, you're saying to yourself, okay, I'm going to go ahead and get in there early. I'm going to be in there first, and I'm going to pay up more than everybody. And my gosh, I'm going to cross my fingers and my toes and hope that I can get an upside move so these things will pay off, right? Instead of, as I said, I think there's going to be a good slingshot move here, but it's not probably right now, right at the open, maybe in a couple of more hours. I doubt it in a couple of hours. Again, we need to see a little bit more fear, and we're seeing some fear in the VIX. We're seeing some fear in the oscillators, but we're not seeing the fear in the put-call ratios, right? Wait till it all lines up, folks. Okay? And Alan's asking, later in the week, do we average down in the same positions or open new calls? Again, I need to wait and have the markets tell me what to do here, Alan. Okay, I don't come in there with a game plan for trading just yet. Okay, especially on a day like today and after a day like Friday, everything is on the table. Every option is on the table. Excuse my analogy there, but it is what it is. Okay, you can't set up for something that you don't know is going to happen yet. Right? Does that make sense? You understand that? As Jim says, manage your size. Timing is a fool's game. Absolutely right. Absolutely right. So, any questions on anything here? I'll wrap it up here in a couple of minutes. Good half an hour. Thank you guys all for coming in. I hope I cleared things up for you. We try to get together when things are a little bit murky. The waters are a little bit cloudy and stuff. But I hope everybody is a little bit more focused right now and can see things a little bit more clear. Any questions on anything at all? You're welcome. Welcome, John. Welcome, Julie. Thank you, Christopher and Lauren. Anybody else? Again, I'd say let's keep an eye on some of these numbers over here. But you know what? They're going to puke the markets here because the European markets puked. And they're gonna puke the markets again over here. So you don't have to be the first one in there. Hopefully some of you guys were able to follow and got some puts late in the day on Friday. That's good. Let's hold on to those for a little bit longer here. As we'll see what happens. I don't think we're going to see. So I'm looking at the ES futures right now. It looks like they rejected it at 27.50. Can everybody see that on the 5-minute? 27.50 seems to be the operative number here in the pre-market here. So we'll see what happens. It's about 7 handles lower. So we'll see what happens later on in the day. I wouldn't be the first one in there. Again, let's just take our time today. All right, let's take our time today and get in and get out where we can. All right. Thanks, everyone. I appreciate everybody joining in with me. It's a good half hour, and I'll see you guys in the chat room in a few minutes. All right. Thanks, everybody. Take care. I'll have if you guys want a copy of the webinar, let me know. I'll go ahead and put it up on Vimeo, and it'll be available. Or maybe I'll put it on YouTube. All right. Thanks, guys. Bye.